Good evening. This side, Rahul Magan here. The world of financial market is broadly divided into four parts. And the biggest chunk of financial market is the fixed income products. And I must admit that the success made by United States and Singapore in the fixed income market is beyond any description. And now both the countries are the Eve League. Eve League means the top countries when it comes to the fixed income market. And still, they are trying hard for more betterment, which is definitely deserve appreciation. When we speak about fixed income market, then there are hundreds of ways to raise the money. And if you are expecting that I'm going to be covering these hundreds of ways in this video, then technically speaking, this is fairly impossible. But one of the ways which I'm planning to cover in this video is known as the bond issuances. And broadly, please note broadly speaking, the bond issuances is divided into two parts. Number one, when it is raised within that country, and number two, when it is raised outside the country. Now, when it is raised within the country, then it is known as domestic bond issuance. On the contrary, when it is raised outside the country, then it is known as cross-border bond issuance. Overnight index swap, OIS curve, and the benchmark curve, which is shortly known as BMK curves, play a very important role when it comes to issuance inside the country. And also when it comes to the issuance which is based in local currency. Now, there are countries in the world who have very deep OIS markets, and there are countries in the world who do not have a deep OIS market. But let me tell you that there are very limited number of people in the financial market who understand what is overnight index swap, and they also understand that how exactly these swaps works. That's very important. We made ample of videos on that, so please don't expect me to repeat overnight index swap again. Now, when it comes to cross-border, then there are another two varieties. Variety number one, when you are inviting the people who are sitting outside to invest in your principal currency. Example, in India, it is known as masala bonds, which is an investor who is sitting outside India is investing in Indian rupees. It is called masala bond. Different countries of the globe have their different bond. Like in China, we call this dim sum bonds. But when it comes to raising the money in a currency which is not your principal currency, it means you are an American entity, but you are raising money in GBP from a bank which is based out England. Or you are a Singaporean bank and you are raising money in England in GBP. It means your principal currency is Singapore dollar, but you are raising in British pound, which means the cross currency exposure comes into the picture. Now, when it comes to the cross currency exposure, then it is a job of that syndication, or if it is a corporate, then it is a job of the Treasury Department to make sure that the cost to the company would be as lowest as possible. As lowest as possible. But There is another problem which we are facing, and that problem is not about the company. That problem is about the syndication which is raising the money. Or rather, it is not a problem, it is a blessing. Take it other way. Now, broadly speaking, the companies are divided into two parts. Number one, who are holding the strong balance sheet. Number two, who are not holding the strong balance sheet. Now, let me explain what is the definition of a strong balance sheet, although this definition is not exhaustive in nature. By exhaustive, it means all probabilities are covered. But I'm repeating, I'm using a word non-exhaustive, which means not all probabilities are covered. So broadly, a strong balance sheet is when you have a huge cash reserves, when your net worth is plus, when on a year to year basis you are declaring a profit, when you are an industry leader, when you have a product which speaks of himself, when you have the domain expertise, basically in so and so industry you are performing, when you are launching a clinch edge products, and there could be numerous factors. But quantitatively speaking, a strong balance sheet is when your top line, your middle line, and your bottom line speaks for himself. This is a strong balance sheet. In fixed income market, we often use a word called tightly priced instrument. You will often get this word on internet websites, some websites, and some maybe indentures which are available in public, or maybe some newspaper clippings and all. Tightly priced instrument. There are a variety of definition of a tightly priced instrument, and today in this set video, I would be covering my own definition of a tightly priced instrument, to whom I define as a tightly priced instrument. In my respectful submission, there are three broad pillars of tightly priced instrument. Now, first of all, tightly priced instruments are only possible, are those instruments which are possible for a company having a very strong balance sheet. So if I speak in the layman parlance, I mean to say that tightly priced instruments are possible for a borrower who is having a command in pricing terms. Generally, borrowers do not have a command in a pricing terms. So if you are a loss-making company, you are holding a huge debt in your balance sheet, there are a lot of issues about your company, the company's sale is consistently falling on year-on-year basis, the net profits has reduced to almost zero, or there are hell lot of factors, then the bargaining power of the borrower is almost negligible as compared to lender. But in case of a strong balance sheet, and I once again repeat that the definition of the strong balance sheet is non-exhaustive in nature. In that way, the bargaining power of the borrower is extremely huge. So let's suppose I am a company, and the name of the company is Rahul Magan Private Limited. Just assume. And this company is currently raising $500 million US dollars. And let's assume that this company is based out somewhere in Europe. Now, since I'm raising the money in dollars, knowing that the principal currency of my company is euro, then first of all, I am taking the risk of euro to dollars in my book, which not only hit me in cash flow term, but also hit me in fair value terms. Many people believe that if I am making, say, less, if I'm getting less interest rate, it means that I am a very, that my pricing is good. But let me tell you that even if you are getting a low interest rate, but you should compute after hedging cost. Ladies and gentlemen, in corporate finance, there are two things. The capital structure of the company should be measured on a fully dilution basis, while the funding which you are taking cross border, because of course, if you are taking inside the country, then there is no hedging cost. But when you are raising the money cross border, then it should be measured on a full hedge basis. It remembers me a story of 2017 when I met up with somebody, say so and so, works in so and so company, and he told me that he is getting a funding of USD to JPY to INR at so and so rate. When I asked him that you please compute on a full hedge basis, then the cost which finally happened inside his book was, and when I had a word with him in 2017, it was a 20-year loan, which means 2037. Then JPY was roughly 80, 85 something, and today it is 147, and it went to high of 161. Which means if it is not hedged at this point of time, I'm not sure whether he hedged it or not. In this eventuality, his PNL is bleeding. But anyways, so the first important thing when I raise the money, I need to see whether the currency pair which I'm taking in my books, that currency pair is expensive in hedging terms or not. Or alternatively speaking, the full hedge basis is so and so percentage as compared to the domestic pricing. So assuming the domestic pricing is 6%, while the non-hedge basis is 4% cross-border. And when I add the hedging cost, including the withholding cost, then it ends up 7.5%. Then who call me intelligent if I'm going cross-border when it is available at 6% in the domestic market? But the only person who can compute the full hedge basis is someone who understands how exactly it works. Second, the syndication which I chose, who helped me in raising the money, I need to see whether they are going fixed price or they are going book building. I repeat, whether they are going fixed price or whether they are going book building. That's another important thing. And I'm not telling you, I'm keeping this open for your knowledge. Many people believe that book building is all about English auction, French auction, and Dutch auction, and book building is done. Do you know what are the two types of book building? This is the auctions in book building. This is not book building. What are the two types of book building? I leave this question to you. Third important thing is the most important element in the tightest price instrument, which is called the credit spread in bookish language. But practically, this is quality spread differential, QSD. And like I said, when a company holding a strong balance sheet, then company holding a positive QSD. While if the company holding a weak balance sheet, then this company holding a weak QSD. How many companies do you see who have a firepower to raise at fixed price and also at floating price as per their own terms? So they can hit the fixed price market, they can hit the floating price market as per their own terms without having any approval from the market. How many companies? I know a few. And it is your QST which determine your credit spread. Many people believe that QST have no role to play in funding, but I am repeating this many times in my career that quality spread differential play a very important role in the funding pattern. If I am a company of a strong balance sheet, which practically means the quality spread differential is very high. And when the quality spread differential is very high, I mean that my credit cost is lower. And when I'm using a word credit cost, I mean to say credit valuation adjustment. Preferably speaking, I should have used net of credit valuation adjustment, which is CVA minus DVA. CVA is what I receive. DVA is what I paid. And I always use a word net CVA, which means what you receive and what you pay should be net off. Until otherwise, the currencies are different and net off is impossible, which is possible, but depend upon case to case. And if your QST is high, then you holding a negotiating power, which practically means you can negotiate with your lender as a borrower that on a yearly basis, I am going to be negotiating my spread. So assuming I, created my own company, Rahul Magan Private Limited, who based out somewhere in Europe, raising a money in whose principal currency is euro, but raising the money in dollar, which means euro dollar risk I'm taking. Currently, it is 1.11 as we speak. In this eventuality, the very important thing I'm going to be discussing with my lender that boss, the credit spread which you are putting is 100 bips. On the contrary, my competitors say PQR, who do not have a strong QST, his credit spread is 150, which means because of the QST, I'm getting a discount factor of 50 basis points. And then I would be discussing with my lender that every year at the end of the year, when suppose the funding is of 10 years, assuming, and when I'm using a word funding, I'm always saying on a fully hedged basis. Because I'm not the kind of person who believing that it is not a fully hedged basis. I'm a person of a fully hedged basis. It means that after 1 year, we will renegotiate this 100 to 90, probably 80, or maybe 120. It depends upon QSD to QSD. It depends how fairly I perform in QSD terms. Today it is so much, tomorrow it is so much. And very important thing, which is called spread guidance. You know what is spread guidance? Spread guidance means when a syndicated opener offer for me. Now it again depends whether a fixed price offer or whether it is a book building offer. Even in the book building, what kind of offer it is, because generally it is of two types. That knowledgeable question I left for you. Now, suppose I given a guidance of 150 basis point. And after getting the bids, suppose I wanted to raise $500 million. And out of this $500 million, I'm getting a bids of 6 billion, which means 12 times. Which means I need to decide whether people are happy with my balance sheet or they are happy with the QSD I'm offering. Because if they are happy with my balance sheet, then I can reduce from 150 basis point to strategy 120 and then later reduce to 100. But if they are happy with my QSD, then I cannot reduce. And last but not the least, the curve. Generally speaking, cross border is Generally speaking, cross-border is CMT swaps. Constant treasury maturity swap means it is linked with the treasury curve of that country. If it is CMT of US, then it is dollar. If it is CMT of England, then it is GBP, and so on and so forth. Like I said, that OIS curve is not liquid for many countries. Benchmark curve is not liquid for many countries, and CMT curve is also not liquid for many countries. Henceforth, ladies and gentlemen, when it comes to a term called tightly priced instrument, then we need to understand that this is a very important term. And it varies from case to case. There is no settled definition. Yes. Broadly, we can have a parameter. That I say, that broadly we can have a parameter. But if anyone believes that there is a well settled definition of a tightly spread instrument, then I am the first person who wish to argue in that. Because that depends upon case to case basis. And another very important thing before winding up is to tell you that as the world is already moved from LIBOR to SOFR, TONA, ESTR, ONIA, SONIA, they all are RFR. SONIA is not a name of a girl. It is a Sterling Overnight Index Average. ESTR, Euro short-term rate, and so on and so forth. Now, when the world has already moved from LIBOR to RFRs, which is called risk-free reference rates. And in a risk-free reference rate, the way we price rollover is different. We were pricing in case of LIBOR. That's very important. In LIBOR, generally people saying 6 months. By default, LIBOR is 6 months plus whatever spread. Some people reduce it to 1 month, they pay higher charges. Some people increase this to 1 year, the charges changes. But the same thing happening in the RFRs also, but in a different way. Henceforth, when we speak about the tightest pricing instrument, we need to understand the majority of the dynamics, which is case to case. And also, I further repeat that the quality spread differential play a very important role in that regards. Very important role in that regards. Good evening, ladies and gentlemen. You have my number, which is right up. Have a good time.